afternoon, everyone, and welcwelcome to Nova 401k Associates webinar presentation, Introduction to 401k Plans for Plan Sponsors. This will be presented today by Charlene DeMartini. She is a Senior Account Manager and also handles our mergers and acquisitions here at Nova. If you have any questions throughout the presentations, please type it in the questions box, and that way Charlene will answer them at the end of the presentation. This recording will be made available on our YouTube channel within 1 week. Just go to YouTube, search Nova 401k Associates, and you can see this presentation as well as several others that we've had throughout the past couple years. Charlene, we are ready to go.
Thanks so much, Andrea. Hello, everyone. Thank you for attending our webcast today. I hope you're all having a great new year. Today, we're going to talk about an introduction to 401k plans for plan sponsors. There's a lot of information in this webcast. Again, as Andrea said, if you have any questions, just type them in the questions box and we'll get to them at the end of the webcast. If for any reason we run out of time, we will email you with the answers because, like I said, there's going to be a lot of information in this webcast. Let's get started. Just a quick disclaimer that the information in this presentation is general in nature and not intended to be substitute for legal or tax advice, and to please consult a qualified professional such as an attorney or accountant if you need legal or tax advice. We do offer CPA credit and we have our provider number there. You must register individually and be present for the entire seminar. Afterwards, you will get an evaluation to complete and you'll receive a certification within 1 week. Quite a few things we're going to go over today. The first is going to be roles and responsibilities, so you know who is included in the administration of your retirement plan. We're going to go over Nova's cybersecurity measures, 401k basics, some moving pieces, distribution basics, loan basics, and then we'll go over an annual calendar of what you can expect throughout the year. The first slide here you might want to keep handy is just the companies that are involved in your retirement plan. So you will first have you as the plan sponsor up here on the top left. As the plan sponsor, you have overall fiduciary responsibility, communicate the plan to participants, remit plan contributions, and provide data to the TPA annually. On the right side here, you'll have the financial advisor or your broker. They will assist with vendor selection and monitoring, coordination of enrollment meetings, provide education to employees, assist the plan sponsor with 404C compliance, which is based on fees and regulations. The bottom right here is TPA, and that's Nova. We will be preparing and maintaining your plan documents, complete required annual testing, prepare annual filings, and provide ongoing plan consulting. And then the left bottom here, you'll have your investment provider, which is the record keeper where the plan assets are held, so the custodian of the plan assets. They invest the plan contributions that you remit and provide daily record keeping, provide participant statements, and they will also complete the distribution withholding and reporting for any distributions from the plan. So this is a quick reference slide of a very brief description of what each party does, and we'll go over some of this information throughout the webcast. The first thing we wanted to do is go over the Nova cybersecurity measures. You may have already seen your data request email requesting your 2021 census data. We have some have gone out today and some will go out on January 18th. So if you don't have it yet, don't panic. You'll be getting yours probably January 18th. But we wanted to go over the cybersecurity measures because there's a lot of confidential information that gets held in those census data files and also information that's held at the record keeper. So there's a tremendous amount of money, as you probably know, in 401k plans. And unfortunately, the bad guys have taken notice of that money opportunity. There have been coordinated attacks on record keepers, and it may start from several different ways, whether it's a phishing attack or hacking an employee's email, contact record keepers to reset passwords. And then with those new passwords, they can request loans and distributions. We have many security measures in place, and that's why we wanted to go over this with you. But with ACH and wires, typically only trivial amounts are covered when the theft is discovered. So good to have security measures on our side as well as your side. Unfortunately, this type of theft is not covered by a Fidelity Bond, fiduciary insurance, or errors and omissions insurance. So again, pretty important to have these security measures in place to avoid any of these attacks of stealing money from the retirement plan. A couple of the things that we have in place are census files, deferral files, payroll files, and address files all include confidential information, as well as the non-discrimination testing. We do have programs that mask the Social Security number, but some software out there may not, but Nova's software does. Annual valuation reports contain confidential information, and then of course on your side, W-2 forms, K-1s, Schedule Cs, and those files quite often are sent to us as well, so we would have that confidential information as well. But we would remind you, as we have in the bottom of our email signature line, that these should never be sent via email without encryption. And we have our own web portal that we'll go over. If you haven't visited our web portal yet, there's another way that you can send us files securely. Our secure web portal is listed here. If you haven't already visited the site, there is a secure file transfer tab that allows you to send a secure transmission to a specific contact at Nova. And that contact at Nova will be alerted that there's been a file uploaded, and they will have to log in with a secure password as well to be able to pull that file down. Here at Nova, we also have encryption software. So if you are receiving an email from us with confidential information, we'll be encrypting that email. And once you receive that email, you'll be asked to log in as well. Also, if you're requesting a new plan contact be added to the plan, we'll usually ask for that in email form so that we can have a record of that request. And that request will need to be completed by either the primary contact that we've already had contact with or the trustee on the plan. So we're not going to just give out information from your plan, obviously, willy-nilly. Mandatory training for all Nova associates every quarter. We have IT training that we must complete and sign off that we've requested that or completed that training. And then a Nova password policy. We have a policy that all passwords be changed every 90 days, and we also sign off on that as well. For the census upload you'll be sending us, if you're not familiar, we request census for the prior year. So in this case, in 2022, we'll be requesting the census data for 2021. This information includes date of birth, date of hire, date of term, compensation, deferral information. So lots of information on a participant, including their Social Security number and name. So we always request that that census information be uploaded to the plan sponsor link so that we can keep that information secure. So you can either upload it to the annual data request or upload that information through the secure file transfer. There's two options. Also, Nova will limit the number of employees, or rather people, copied on email so that we don't have the information going all over the place. And also, we suggest, and we do, use complex passwords and change them often, as in our case, every 90 days. So with that being said, we just want to go over the security measures that we're taking and some security measures to take on your side as we're requesting this confidential information each year. And with that census data, we will start the retirement plan testing starting really now. People are already submitting their data, and we're going to go over some 401k basics so that you know what to expect. For a retirement plan, it gives employees an opportunity to save for retirement on a tax-preferred basis. It's easy for the employee because it's all made through payroll deduction. And so for that reason, many people, their 401k is the biggest asset outside of their home. 401k plans have become the primary retirement plan for most people. They don't have to go searching for something. They get the paperwork from the employer, they sign up, and it comes out through their check and gets invested for them. Otherwise, the only thing they need to do is update the elections or check out the record keeper to see their assets grow for the retirement plan. So it's become a valuable employee benefit. I haven't become aware of an employer yet that doesn't have a retirement plan, so employees are definitely looking for a retirement plan as part of their benefit. Even though it's easy on the participant side, 401k plans are heavily regulated by the IRS and Department of Labor, and in most circumstances, common sense doesn't always help. It's just the way the regulations are written, and we're going to go over a couple of those instances where you think that maybe it should be administered one way, but because of retirement laws, it's administered a different way. And we are here to help. So whoever your account manager is, please reach out to them if you have any questions, as the rules frequently change. And again, they're heavily regulated. So we are here to answer any of your questions and be your expert in this circumstance. In almost all cases, your written plan document controls, and we'll go over the plan document as well, or at least a few. We'll touch on the plan document, I should say. We won't go through an entire plan document. Otherwise, we may have you guys falling asleep. A lot of legalese in there. Again, the retirement plans are heavily regulated. And in this circumstance, the IRS really is making sure that you are compliant with the federal and statute and IRS regulation. Non-discrimination testing that we complete each year, and we're going to go over some of that as well. Taxable events and deduction limits are met. The plan document is timely amended, and the terms of the plan document are followed. On the other side, you have the Department of Labor, and the Department of Labor is more concerned with the rights of the participants. So they are going to concern themselves with the 401k contributions and loan repayments being deposited timely, that the lineup offered to participants is prudent, and we'll go over a little bit of that as an example. The expenses paid by the plan is reasonable, and the Form 5500 is submitted to the Department of Labor timely. So a couple of things we want to go over with things that maybe make sense on other benefits but don't necessarily apply to the retirement plan. The first example we have here is that you want to exclude hourly employees from the 401k plan. You can exclude certain classes of employees. However, with most things in retirement plan, there is testing that's required to make sure that it's non-discriminatory. So the document would first need to be specified that you exclude certain employees, in this case, hourly employees. And then we would complete a coverage testing each year to make sure that you're covering at least 70% of the eligible population. So if we look at an example, you have 100 participants that are eligible for the plan, and you want to exclude, I don't know, just make it round numbers, we'll say 30 employees or hourly employees are being excluded. With those numbers, you would be at 70% and pass the coverage testing. So if you excluded more than 30 employees from that 100 employees, you would not pass the coverage testing. And again, that's something we would look at each year and test. The second example we have here is the plan document. Well, I guess included in this example, as I already mentioned, is the plan document needs to be written to exclude hourly employees. So we always want to make sure that the document is written the way that you are administering the plan. And again, the plan must be able to pass IRS coverage testing. Our example 2 is, what is the preferred investment alternative for an employee who puts money into a 401k plan but fails to make an investment selection? So in this example, we have an employee who isn't making salary deferrals, for example. So they don't have a account set up as a vendor, but maybe you're making a profit sharing for 2021. So you don't have an account to deposit those funds in because they've never set up an account, as they've never put in their own money. You can do what's called default enroll that participant, and their funds will be defaulted into preferred investment alternative. And then they can make a change of those funds later on. But in this example, what would be the preferred investment alternative? Up until fairly recently, most people would have probably said a money market account, because typically in a money market account, you're going to get dollar for dollar for that investment. But in a down market, those money market and stable value funds could actually lose money because of the expenses that are applied to those funds. So until recently, until a few years ago, the Department of Labor regulations now list a balanced fund or life cycle fund to be the default for a qualified default investment alternative. And so that those funds would be deposited and invested based on their retirement age, and so automatically balancing for that participant, that specific participant. As I mentioned, the Department of Labor is going to be concerned with timely deposits of 401k contributions and loan repayments. So those contributions that are coming from the paychecks to the retirement plan. There is a safe harbor time frame for small plans, which is plans with less than 100 participants. It's going to be the 7th business day after amounts withheld. So within 7 business days after those amounts are withheld from the paycheck, those deposits must be made. If they aren't made, they're not considered timely, and there might be some investment earnings that are due to participants from when they should have been deposited. So it's very important to make sure that you know the guidelines for a timely deposit and make sure that you're meeting those parameters. It'll be the first thing that either a DOL or IRS auditor is going to look at, as well as if you have over 100 participants and require an independent audit each year, it's the first thing that auditor is going to look at each year. And so in saying that, when we move over to a large plan with more than 100 participants, the regulations are a little bit different. It's deposit the earlier of, as soon as administratively possible, or the 15th business day of the month following. I've not seen a circumstance where an auditor has said the 15th business day of the month is feasible. You always want to have as soon as administratively possible to pull those funds and deposit to the record keeper, even if you have more than 100 participants. So typically when you're able to deposit your employment taxes, that's when the Department of Labor is going to want to see those deferrals being deposited to a participant. So as soon as you can get them in there, and typically auditors are looking at 3, 4, 5 business days following the withholding. So just check in and make sure how often you're depositing and adjust that if necessary. Again, it's a huge issue in the Department of Labor audit and for plans subject to CPA audit. So that'll be the first thing that they want to see usually is a listing of your payroll dates and when you've deposited those funds. Also for the Department of Labor is making sure the 5500 is submitted timely. The 5500, if you're not familiar, is an annual report for the plan. It's a plan-specific filing, not employee-specific. So it's going to contain the information on the plan as far as participant count, fees paid from the plan, the income statement, financial statement, the amount of withdrawals that were made, the amount of deposits that were made, the earnings, all of that information on a plan-specific basis. And those 5500s are required to be electronically filed. So once we complete the draft of your 5500, you'll be able to review that, download it and review it, and then electronically file that filing. The 5500 must also report the amount of the plan's Fidelity Bonds. Plans are required to have a Fidelity Bond, and if you're not familiar, a Fidelity Bond is an insurance policy that covers any theft or fraud from the plan. The Fidelity Bond must be in the amount of 10% of the plan asset and no greater than a $500,000 bond if you have qualified assets. So just check your files, make sure you have a Fidelity Bond on file. We will ask for that information when we ask for the annual census data. As I said, some of those have already gone out. So one of the questions is going to ask for the amount of your Fidelity Bond. Certain plans must attach a copy of an audit report. So if you have a plan that has more than 100 participants that are eligible, then you're required to have an independent audit by a CPA. And there are some transition rules. So if you hover between 100 and 120, between 80 and 120 employees, there's going to be some transition rules for when you can still be considered a small filer versus a large filer. And those large filers are the ones that are going to require this independent audit from a CPA. We also wanted to go over the payroll integration. You may have payroll integration already, but if not, just something for you to look into to let you know what it is. This is when the payroll provider submits, or can be when a payroll provider could submit full census data each pay period. So if you have a payroll provider that works with your record keeper, just for example, say you have Paylocity as your payroll provider and you have John Hancock as your record keeper. This would be for where Paylocity could send a full census data file to John Hancock each pay period. This full census data would include addresses, dates of birth, dates of hire, termination, compensation, deferral information, etc. This would be for all employees, regardless if they defer. So instead of just sending a file to the record keeper of who is just deferring, you would send a full census file of everyone that received a paycheck. Why would you want to use payroll integration? There's several great reasons. Firstly, the annual census data could be pulled from the record keeper. So if you're submitting every pay period, you could pull an annual census file and submit that to NOVA for your testing for that year. Secondly, automatic distributions to participants. Once the record keeper receives a termination date, that will trigger the vendor to send a distribution packet to the participant. If the participant has less than $5,000, if there's no response between 30 and 45 days, depending on the record keeper, they will go ahead and force out that account balance to an IRA if it's less than $5,000. So just kind of helping you with not having to complete this administration. If the termination date's automatically sent with the census file, it could initiate this process as well. Next, the vendor could track enrollment. Again, each record keeper is different, but most record keepers, if they receive a full census file, they're going to receive information on who your new hires are. If they have the enrollment data there, who's eligible for a plan, they can send that new participant the enrollment packet to get them started. So again, something that could be taken off of your desk to have to worry about enrollment for participants. Then also, I think this is probably one of the biggest items, is the census data is updated at the vendor. If a participant has an address change, their name changes, they have a date of rehire, that information would automatically be sent to the record keeper in this full census file, And so it eliminates you or the participant having to go into the record keeper and update that information. There are two types of payroll integration. Again, depending on your payroll provider and your record keeper, they could provide Payroll 360. Payroll 360 is where the census data flows both ways. Not only is the census data being provided to the record keeper that we just talked about with all the different benefits, but also if a participant goes into the record keeper and requests a deferral change or a hardship request, a loan request, those items would go over to the payroll vendor or you as the payroll contact to be able to be notified of those changes. So again, the Payroll 360 is just that. It goes both ways. Some record keepers and payroll companies can access just Payroll 180, which just means the census data flows only one way. So that way would be from the census data being provided to the record keeper from the payroll vendor. So in this case, you wouldn't have this second portion where the payroll changes are provided to the payroll vendor. You'll just have the one way. But I think that you probably see that this has a lot of benefits to you as an administrator. So if that's something you're interested in, just contact your record keeper and your payroll company to see if they have those options available. And then of course you can always reach out to your NOVA account manager that can help initiate that as well. Just again, something to keep in mind, ongoing administration. The next thing we're going to talk about is the testing that we complete each year. So as I stated, we are requesting census data now for 2021, and we will be completing several different non-discrimination testings depending on what your plan provides. All the plans will provide ADP testing, which is average deferral percentage testing. And this is the test in which the amount of deferrals from the highly compensated employees are compared to those of the non-highly compensated employees. A ADP test can be corrected two ways. One is to issue taxable refunds to the highly compensated employees, and the other is to increase the amounts given to non-highly compensated employees. So the first thing we're going to do is we're going to determine who a highly compensated employee is. And a highly compensated is defined in the regulations. And for 2021, which is the year we're going to be working on now, any employee in the testing year who earned more than $130,000 in the prior year. So if you get questions from your account manager of who made $130,000 or more in 2020, this is why. We are determining who is a highly compensated employee for 2021, which is the current testing year. A greater than 5% owner, or any lineal family member or spouse of a direct 5% owner that is working at the company. So you'll see on your census request that we're going to have some questions, and there's going to be a tab asking for the ownership, and there's going to be a tab asking for family members. This is specifically why we're asking for this determination. So once we have those employees that are considered a highly compensated employee and those that are considered non-highly, we're going to compare the percentages of each group. The percentages for the highly compensated group cannot be more than 2 percentage points higher than the non-highly group. So for example, if we have the non-highly group is deferring as an average 4% of pay, the average for the highly compensated group could not be more than 6% of pay. If it is, as with everything with a retirement plan, there's a fix, and that fix would be to refund enough money from the highly compensated group to bring them within the 2 percentage points, or increase the amount given to employees as an employer contribution to make it within 4 percentage points. So we either bring it down or bring one group up. It's probably more information that you wanted to know. But we just wanted to give you kind of an overview of what we're going to be doing for the testing. And this is one of the reasons that we're requesting this information. The next test that we're going to be doing is the top-heavy test. Similar to the ADP testing, we're still going to break the plan up into two groups. But in this case, we're going to break up the groups into key employees versus non-key employees. Very similar in definition, but a little bit different. So if we look at that definition right quick, a key employee is going to be any employee who's greater than a 5% owner, a 1% owner with compensation greater than $150,000, an officer with compensation greater than $185,000, or a lineal family member or spouse of a direct 5% owner. So again, we're asking these specific questions on our questionnaire, and this is, again, the reason we're asking a little bit different definition, but for a different test. So when we look at this top-heavy, now that we've divided the plan into key and non-key employees, we're going to look at the total account balances in the plan that are not rollovers. So we're going to look at deferrals, employer contributions, any balances in the plan that are not unrelated rollovers. If the balance for the key employees are more than 60% of the total balances of the plan is considered top-heavy. When a plan is considered top-heavy, there's certain contributions that are necessary to the non-key employees. Typically, it's 3%. It could be less, but kind of a guideline to take away from this would be to expect 3% contribution to be necessary. There are ways to avoid failing either of these tests that we just talked about, and that's to make the plan a safe harbor. So if you've heard that term with your plan, a safe harbor plan, you are exempt from the ADP ACP testing, so that's deferral and matching testing, and the top-heavy test. And we're going to go over what some of those safe harbor plans look like. There's a couple of types of safe harbor plans. The most common is going to be this formula here that we have for the matching. It's a basic matching formula with two tiers. So the first tier is going to be 100% of the first 3% deferred, plus a 50% match of the next 2% contributed. So in this case, we have 100% on the first 3, 50% on the next 2. So you're going to be matched on any deferrals of up to 5% of pay. The second portion, or a different type of safe harbor plan, is a non-elective. And this is when employees receive 3% of pay, regardless of whether they contribute or not. So in the first example, it's going to be when a participant defers and they're getting matched on that contribution that they've made. The second part, or separate option, I should say, is a 3% of pay, regardless if they contribute or not. There are many other formulas that are available under Safe Harbor, but these are the two most popular formulas. With this, there's an annual notice that's required to be given to participants each year. So for 2022, that notice would have been given by December 1st of 2021 for the 2022 plan year. That notice will list the formula that is selected by the employer in the plan document. And also, these contributions carry 100% vested contribution immediately. So where some of your other contributions you may have seen to a plan, you might have seen a vesting schedule. These are automatically 100% vested. So it's great that it can help you in a plan that you may be failing deferral testing or the top-heavy testing. This could help satisfy that requirement. So if you don't have a safe harbor yet, one of the things that we do in our testing is if your plan fails testing, we can provide an estimate of what it would have looked at like if your plan would have been safe harbor. So what would have been the cost versus what you're giving back in refunds to the highly compensated employees. So we'll give you something to look at for the following year if you're not passing those tests. Some other testing that we complete depending on your plan. The first one we talked about earlier, coverage testing. So if you're excluding certain employees from the plan, we'll complete coverage testing for your plan. Profit sharing testing. If you're contributing profit sharing for the plan, we will test those. Similar to how we did the deferral testing where we break the plan into 2 groups, but there's a lot of additional testing needed for profit sharing. Another option or another test that we could run is compensation testing. And this is going to be for any plans that exclude certain types of compensation from the plan. You could exclude, for instance, bonuses from any deferral elections or any matching contributions. But if you do, you'll be subject to compensation testing. And sometimes it will pass, sometimes it won't. Again, there's a fix for everything in retirement plans. If the plan doesn't pass, there's a fix for that. We would bring in enough compensation till we pass that testing. But again, if you exclude certain types of compensation, then we'll just have to complete this non-discrimination testing each year. As we stated earlier, the Department of Labor looks at plan documents being amended timely. So you have the right to amend your plan from time to time, first of all, to stay current with new legislation and IRS regulations, but also discretionary amendments. For instance, if you're listening to this webcast and you decide that you want to change to a safe harbor plan, your account manager can help determine when that can be effective, and then we will create an amendment to the plan, and then we will want to make sure that amendment is executed timely so that you can start using that provision. There are penalties that apply from the Department of Labor, or rather the IRS, for plan documents that are not signed timely. So we want to make sure that they are, and you will hear from your account manager from time to time asking you, have you signed these? Typically, we do these through DocuSign now, so we can have an automatic signature come back to us. But in the case that you are signing a paper copy, then we would just need to make sure that we have a executed amendment on file. You need to make sure that the terms of the plan document are being followed. There's lots of information in your plan document. It is the legal document that defines the plan. So it has many provisions in the plan document. This is just a few, but some of the more commonly used definitions that you'll want to look at. First is eligibility, when a participant is eligible for the plan. Once the participant meets that eligibility requirement, when can they enter the plan, which is called an entry date. The compensation that's used in any of the definitions for the plan. And again, we talked about you can exclude certain compensation such as bonuses or commissions or fringe benefits. So if those are things that you're interested in excluding or you're not sure if your plan document has that already, talk to your account manager. The employer contributions that are available in the plan, you could have a discretionary match, discretionary profit sharing contribution, or as we just talked about, you could have safe harbor contributions as well. And the vesting. So we talked about safe harbor contributions are 100% vested immediately, but the vesting section would also include the discretionary match and discretionary profit sharing vesting as well. When we take over a plan, we often see some common errors that occur, and we kind of wanted to bring this to your attention just to keep an eye out for things that you may be doing that's different than what your plan document may include. The first is excluding bonuses from deferral elections. So we just talked about that you can exclude certain compensation for plan purposes, but again, we need to make sure that the plan document states that you're excluding that compensation in their definition. So we just want to make sure that that definition is being used. Secondly, excluding part-time employees from the plan. Part-time employees may not be eligible for your other benefits, but again, when we talked about some things aren't, common sense and kind of are followed throughout all of your benefits, the plan must state that you're excluding part-time employees from the plan. They're not automatically excluded. So if, for example, you have a plan that has 3-month eligibility, if a part-time employee has worked 3 months, they're eligible just as much as your full-time employees are. So we'll need to make sure that if you're excluding employees, that we make the document match what you're currently doing in the plan. Next, matching catch-up contributions separately than non-catch-up contributions. If you're familiar, there's catch-up contributions that are allowed for participants who are 50 years or older, and that's a catch-up of deferrals. So for the current year, $6,500 in addition to the regular deferrals that a person that's 50 years or older can contribute. Those contributions would be matched just like any other deferral is. Same goes for Roth contributions. If you're offering Roth and pre-tax contributions in the plan, both of them are considered salary deferrals. The difference is they're taxed differently. In a Roth contribution, it's going to be taxed when it comes out of the paycheck. Pre-tax is not going to be taxed when it comes out of the paycheck. They're both considered deferrals and apply to the same limits, and so they both get the same matching formula. Next, not distributing the summary plan description. So we talked about how the plan document or the adoption agreement includes a bunch of provisions in the plan that need to be followed, and it's the legal plan document. In addition to that item, you will have a summary plan description. The summary plan description has the same information, but it's in more of a booklet form for the participant. So it's more layman's language of the plan. So there'll be questions, for instance, what is the eligibility for my plan? When am I eligible? And it'll have a paragraph of when they're eligible. Same with compensation, same with vesting, all those different provisions, just in a different format. And that summary plan description needs to be distributed to participants. It needs to be distributed to participants that are newly eligible for the plan. And also, if there's any changes in the plan provisions, a new summary plan description should be distributed as well. So we would advise that when you are completing an enrollment packet for a participant, providing that enrollment packet to a participant, include the summary plan description in that enrollment packet. That way you know that they've received the summary plan description and you don't have to keep track of 2 different timelines. The next error that we see is not allowing new employees to participate pursuant to the plan. So again, we talked about that the adoption agreement includes eligibility requirements for when an employee can come into the plan. Just make sure that you understand those provisions and allow the participants to come in when they need to. Again, there's fixes to everything. If you're not allowing people to come into the plan when they should be coming into the plan, you could incur a penalty. It's called a missed deferral opportunity. So there could be a contribution that's due to that participant for the time frame that they were not allowed to participate in the plan. So just reach out to your account manager to go over your eligibility rules to make sure that you're understanding when a participant is eligible. The next error that we see is not capping the matching contribution based on the annual compensation cap. And we have an example of this scenario. Here it is. So, excuse me. In this example, if you have a plan, if your plan has a matching formula of 50% match on the first 6% of the deferral, then the maximum matching amount to any participant is $8,700. The way we come to that is using the compensation limit for 2021, which is $290,000. Typically, that compensation limit changes year to year. So you'll want to make sure that you have the new compensation limit set up in your payroll system. So the maximum match we determine is $290,000, the compensation limit for 2021, times a 50% match, times 6% deferral is a maximum of $8,700. So each year, depending on your matching formula, you may need to update that $8,700 in your system to make sure that the system doesn't match anyone over $8,700. Going back to the allowing participants to enroll on time, we have an example of when a participant would be eligible based on certain circumstances. In this example, if your company has no age or service requirement, but you don't offer the plan to, for instance, Steve for 6 months, you may need to make an employer contribution to the plan for that 6 months that Steve was not eligible for the plan. If we go over a specific example of an enrollment with 1 year wait, the initial eligibility for the plan that we're going to look at does have the maximum waiting period of 1 year, age 21, with a minimum of 2 entry dates. You can require a certain number of hours be required in order to accrue the 1 year of service, but it can't be more than 1,000 hours. Typically, it's 1,000 hours if you're using 1 year of service. An age requirement cannot exceed 21. You can certainly have shorter waiting periods than 1 year, but our example will go through 1 year eligibility. And the initial computation period is the 12-month anniversary from the date of hire, and then typically it will change to a plan year. So it's a little easier to see this in actuality on numbers versus reading through a list here. So we're going to go through an example. In our example, we have 1 year eligibility with semi-annual entry dates. In this example, we have a person who was hired June 1st of 2021. As we talked about, the first computation period is the 12-month anniversary from the date of hire. So the first year we're going to look at, since we have 1 year of service wait, June 1st, 2021 through June 1st, 2022. If the participant had over 1,000 hours within this first year of service, they would enter the plan on the next entry date, in this example, semi-annual. So we're going to enter 7/1/2022. If a participant did not have 1,000 hours in this first year, this is when the computation period will switch to the plan year, in this case, a calendar year, 1/1/2022 through 12/31/2022. So again, we have a participant who did not work 1,000 hours in the first computation period. So we're going to look at the second computation period, which is 1/1 through 12/31. If they worked 1,000 hours in this computation period, but not the first computation period, they'll be eligible 1/1/2023. So you can see there could be a 6-month difference in their eligibility date, depending on if they worked 1,000 hours in that first year. So again, it's usually easier when you look at a specific example. So if there's a participant, if you have 1 year of service and there's a participant that you need to figure out if they're eligible for the plan or when they will be eligible for a plan, just reach out to your account manager at Nova and we can help you through that computation. Rehires. Rehires can get a little more complicated than your regular eligibility, but these are some general takeaways. The first is if a formerly eligible employee ever had a single vested dollar in the plan, he never loses their prior service credits. So you would always include their original date of hire in the calculation of eligibility. Otherwise, they lose their prior service credits after 5 consecutive 1-year breaks in service. So after 5 years of not having at least 500 hours, the participant would then lose their prior service credits. Typically, if you're going to have a rehire, it's going to be within this 5-year break in service. So typically this second scenario probably won't apply to you. But it's important for rehires that you take away this fact, that if they ever had this single vested dollar in the plan, they don't lose their prior service credit. So if a participant was eligible for the plan before they terminated and they're rehired, they are eligible immediately on date of rehire. So you'll want to make sure that you're not making them wait a new eligibility period, not till the next entry date. They will be eligible immediately upon rehire, and so they should be offered the plan upon rehire. And again, I know I keep saying this, but if you ever have any questions about a rehire especially, contact your account manager. We can help you through the specific circumstance of that individual. The moving pieces on a plan, this is going to look similar to the first slide I showed you of who is responsible for what function in the plan. This is very similar, where the record keeper, the investment provider, they're going to have they have the multi-manager investment portfolio, so all the funds that are available in the plan, the investment transaction, plan sponsor and participant reporting, education and communication. Very similar to what we went over earlier, but what we're going to do is we're going to go through who is responsible for certain moving pieces that are most frequently used. The first one, and really probably most important to most of you, is how does the money get to the record keeper? So you've withheld the contributions from the participant's paycheck. How do I get that to the record keeper, whether it be John Hancock, Voya, a Census, American Funds, whatever record keeper you use? Most record keepers provide a secure website for you to be able to upload that contribution information. Hopefully it's not manual, but if you have a company that only has a few employees, you could easily enter that information manually for a couple of employees. But if you have a larger population of employees, and probably more than 5-10 employees, I would say, you're going to want to have a spreadsheet that's easily uploaded to the vendor. If you have the payroll integration, as we talked about earlier, it's going to be full census data. If you only are uploading the information from that paycheck for those deferrals, you might only have a couple of columns to that Excel file. But either way, it's going to be easier and less errors if you have an Excel file that you can upload to the vendor. But again, they'll have a secure website that has an option to enter a new payroll, and then that new payroll option will be the ability to either manually or upload an Excel file. When that information is uploaded, it's by money type. So the record keeper is going to track it by money type as well for the participant. You might have, we talked about pre-tax deferrals, Roth deferrals. You could have a safe harbor contribution. Any of that information is going to be tracked separately and therefore needs to be uploaded separately. It doesn't necessarily mean it's a separate Excel file. It could be on the same Excel file, but a separate column. Who calculates employer matching contributions? There's a couple of ways this can be completed, but if you are completing your match calculation on a payroll by payroll basis, typically it's either going to be your payroll company or you as the plan sponsor that's calculating that match. We also have a spreadsheet that can help you in calculating that match as well, if that's something that interests you. But typically it can be set up through the payroll company as a memo file, and the memo file will have the formula that you want to use for that year. As we talked about earlier, just make sure that memo file is updated each year with the maximum compensation and the maximum match that's eligible for that year. If you want to calculate the match annually, NOVA can complete that for you. Once we receive the census data for the prior year, in this case 2021, we'll take that information, and when we're completing the testing, we'll calculate the match for you as well. and we'll provide a spreadsheet for how much match is to be contributed for each participant that's eligible. So either way you want to do it, typically employers will want to do payroll by payroll because the employees see that money going into their plan, and it incentivizes people to be participating all year round and see their match coming in during the year. But again, it's up to you. Neither one is wrong, just may be different based on the demographics of your company or the wishes of your company. Who's responsible for preparing the 5500? Unless it's a special engagement, Nova's going to prepare that as well. And so once we finish the testing, there's a big deadline. You may be aware of a testing deadline of March 15th. Once we get through the March 15th deadline, we'll start on 5500s in which we've already completed the testing and get that 5500 draft to you to review and file before the due date. When we send that over to you, it is your responsibility to review the 5500, electronically sign it, and submit it to the Department of Labor. Of course, call us with any questions that you have about the information that's being listed, maybe where we got the information. Typically, it's going to be from our records, from the census data, and also the record keeper's information. How does an employee get distribution paperwork upon termination of employment? I'm sure it's probably the first thing you hear when a participant terminates employment is, how do I get my money? We suggest that you give the employee this information when you're having their exit interview and they're getting their COBRA notices or whatever other benefit information you need to give them at their exit interview. This will first ensure that they got the distribution paperwork, and so they can start their process immediately. Secondly, we advise this because, as we talked about earlier, you may have a force-out provision in your plan for account balances of less than $5,000. If you don't hear back from an employee within 30 days, you can force their funds over to an IRA, and so out of your plan, and they will have to take care of it from there. It keeps your plan clean. And so in this case, it'll start your 30-day clock if you give it to them at their exit interview. And so you can have in your files, we gave them the paperwork, we gave them the notification that they have money in the plan and need to act on their request within 30 days. Upon request, we can mail this information to employees. And as we talked about before, if you have payroll integration, typically the record keeper can take care of that for you. So several ways that can get to the participant. Who is responsible for distributing required notices? You may already know that there's quite a few required notices with a retirement plan, especially if you have certain provisions in the plan. These are going to be typically from the employer, but we'll go through each one. The summary plan description, as we talked about earlier, the booklet for participants, that's going to be the employer's responsibility to distribute to participants. Summary annual report, also the responsibility of the employer to distribute to participants. The summary annual report, if you're not familiar, is a summary of what's been reported on the 5500, and that's required to be given to the participants. Again, just like the summary plan description, it's in a different format of the 5500, but same information is included. Special tax notice. The special tax notice typically is going to be part of a distribution form. The special tax notice describes the tax implications of how a participant takes their distribution, what the taxation would be if you, for instance, rolled over your money versus what it is if you take cash. So that's required to be given to a participant. Typically, like I said, it's going to be part of the distribution notice. Sometimes it's a separate notice. Annual safe harbor notices. If your plan is a safe harbor plan, that is required to be distributed to participants each year by December 1st of the year preceding. So December 1st of 2021, you would have distributed the notice for 2022. and that would be from the employer as well. The next is the annual 404A5 fee disclosure notice. Typically, that can be either the record keepers or that would be you as the plan sponsor. A 404A5 fee disclosure is just what it says. It's a fee disclosure of what fees a participant will be charged, whether it's from the fund company or if it's a distribution fee or a loan fee, any kind of fees that may be applied to a participant's account as a record keeper. And lastly is the annual automatic enrollment notice. If your plan has auto enrollment, which is an opt out of the plan versus opt in, so a participant would be automatically enrolled if they didn't make an opt out enrollment, that annual notice would also come from you guys as the plan sponsor. So now that we've talked about a very overall basics of a retirement plan, and I know it's been a lot of information. Hopefully you guys are still awake out there. We got a little bit longer to go, but we're going to go over some distribution basics and some loan basics of how participants get money out of the plan if they wish to get money out of the plan. I'm going to take a drink right quick. Hold on one second. Sorry about that. So one very important item to remember is once money goes into a retirement plan, it becomes subject to rules of when it can leave the plan. You might get participants, maybe pretty often, that say, but it's my money, I should be able to get it whenever I want. Unfortunately, that's not the case. It is there for retirement, and there are distributable events to when a participant can take their money. And so you can allow certain parameters for when a participant can take the money to make it easier, if you will, to get money out of the plan, but still have to meet certain parameters by regulation. So it's important for a participant to know that once the money goes in the 401k plan, it's not just their money to do as they please. There's going to be certain rules to when they can take that money out. And we're going to go over each of these items. The first is termination of employment or retirement. If they terminate employment, they're eligible to take their distribution. Age 59 and a half, and we'll go over what that means. Hardship, we'll go over that as well. And then, unfortunately, if a participant passes away or becomes disabled. So if we look at a termination of employment, the withdrawal fund form can be submitted prior to an employee's termination date, but the funds cannot be removed until the last day worked. So if a participant terminates today, if a participant terminates next Friday, you can submit their paperwork today, but the distribution cannot occur until next Friday, which is their termination date. Most record keepers will not distribute the funds until after the final payroll contribution is received. So you'll see a option on the form to complete the date in which the final payroll contribution will occur for the participant. So if we take the example of a participant terminating next Friday, and they are not getting paid on that, sorry, I'm trying to look up my calendar so I can give you some dates. So if they're terminating on January 21st and their final paycheck would be January 28th, you will be marking on the record keeper distribution form that the final contribution will be made on pay period 1/28/22. And so those funds will be distributed after that final payroll contribution is received. In addition, as we talked about earlier, provide the tax notice to participants with that distribution form. And again, it's probably part of the distribution form, but just make sure that you have that in addition if it's two separate items. Another option for withdrawing money is an age 59 and a half, and that's typically referred to as an in-service withdrawal. So this is a withdrawal for participants that is not required. You can elect to offer this, and most plans do, but it offers employees the ability to take distributions at age 59 and a half. And there's a couple of reasons for this. The first is typically, can't say always because I'm not an accountant, but typically at age 59 and a half, the 10% penalty, early withdrawal penalty will go away. So that's one reason that 59 and a half is the magic number for in-service withdrawal. And then also employees want to start making preparations for retirement while they're still working. So they may want to move those funds to their financial advisor that they have personally versus having that in the plan until they actually retire. So again, it's optional. You don't have to offer these, but it's just a kind of nice to have in case of participants either wanting to get ready for retirement. They don't have to take it because they're getting ready to retire. They can take it for any reason after 59 and a half. But it just, again, it allows participants kind of the peace of mind that they can start withdrawing that money at 59 and a half. Next is hardship distributions. This is another that is not required to be offered in the plan, but again, offers a participant peace of mind in case they need to take some distributions from the plan. This is a hardship withdrawal, and it's subject to certain requirements by law. So if a person has an emergency, and we're going to go over what requirements there are, but if they have an emergency, they can access some of their funds. Typically, they're still going to be subject to that 10% early withdrawal tax if they're less than 59 and a half. So it is nice to have in the plan if a participant has an emergency, but it is going to be subject to the 10% early withdrawal tax, and it's also going to be taxable distribution. So not ideal to take a hardship distribution, but again, participants have issues all the time when they need funds. It's for us to judge, and they would probably rather not take a hardship distribution, but there are certain requirements for how they can take those funds. So typically we will see this in a retirement plan. Those allowable reasons are listed here: purchase of a principal residence, prevention or eviction from prevent an eviction from a home, unreimbursed medical expenses, post-secondary education, casualty losses from a storm, a flood, those types of instances, and burial expenses. So you can see that these aren't taken lightly. These are major expenses that a participant could incur. And so we do typically advise to have hardship withdrawals in the plan as an option because there's no negative impact on you as the plan sponsor, but it does give participants a peace of mind that if they did incur some of these unforeseeable events, that they might need to be taking funds from the retirement plan. There are some hardship distribution rules that went into place 1/1/19. You may be familiar with some old rules, so we wanted to include here what is now new or what went away. The first thing that went away is that they used to require that if the plan allowed loans, the participant would take a loan prior to taking a hardship withdrawal. This is no longer the case. So a participant does not have to take a loan prior to getting a hardship distribution. They can go straight to the hardship distribution option. Secondly, for a hardship, you used to have to stop contributing to a retirement plan for 6 months. This is no longer the case. You can take a hardship distribution and still be contributing on a payroll by payroll basis for your retirement plan. Next, investment earnings for employee deferrals are now available for withdrawal. Previously, earnings from deferrals were not allowed to be taken for a hardship. So again, they are allowed now. Employer contributions may be available for hardship distributions. There are some employers who would rather an employee, if they have a hardship, only take their own funds. So pre-tax or Roth deferrals or rollover funds. You can still enter that into the plan document as a provision and not allow, for instance, employer match or profit sharing available for hardship withdrawal. It's totally up to you. Safe harbor contributions are now available for hardship withdrawals. Previously, it was only discretionary match and discretionary profit sharing. Now you can also offer the safe harbor contributions available. In prior documents, we didn't automatically put in safe harbor contributions to be eligible. So please contact your account manager if you want to change that to include safe harbor contributions. So lots of different flexibility with what you can offer and what is now in the regulations versus what wasn't in the regulations. Next, if you have the unfortunate circumstance of a participant passing away, the funds are distributed according to the participant beneficiary election. If a beneficiary form is not on file, the plan document does tell us how to distribute the account. If there is not a beneficiary election, it will first go to the spouse. If there's no spouse, then it will go to the beneficiary's children. If there's no children, it will go to the parents. No parents, it will go to the estate. So there's a definite hierarchy, but to avoid any of that hierarchy and get the money to where a participant would rather the funds go to, you would want to have the beneficiary election on file. Married participants, if you don't want to have a spouse, the spouse as your beneficiary, there is a spousal consent that's required. So a spouse, as we said in the hierarchy, is going to be the first beneficiary that's eligible for that distribution. So if you don't want to have your spouse as the beneficiary, there needs to be a spousal consent on file. Age 72 distributions. If you're new to the retirement plan, you might not have heard of these, but if you have been around for, well, up till last year, these used to be age 70.5 distributions. The regulations have now changed that from 70.5 to age 72. If you have a participant who was already eligible for 70.5 distributions, they'll continue those distributions. But if you have a participant who is now newly turning 72 and has not been required to take a minimum required distribution, they will at age 72. So beginning in the year that an employee or former employee turns age 72, they must begin taking out money from the 401k plan. Uncle Sam wants to start getting their tax money. So generally, if a non-owner employee is still working for you, they can delay taking an age 72 distribution until they terminate. So again, non-owner employee that's still employed can delay until they terminate employment. Until they terminate employment. If you have an owner who has turned 72, they cannot delay their distribution. So an owner who's turned 72 does not have to terminate employment. They either actively or terminating employment will need to start taking age 72 distributions. We'll go over this in the annual calendar, but just so you know that in typically September, October timeframe, we start pulling reports of who is age 72 in your plan, and we'll send you a list of who those employees are and ask you if they're actively employed or have terminated employment so that we can let you know who is required to take these distributions. And then once we know who is required to take a distribution, we will send you a signature ready form, and those forms must be processed by December 31st each year. So that'll take a little bit off your plate in case you're worrying about who is eligible for these distributions. We will send you a listing each year. Another distribution from the plan can be a quadro, which is a qualified domestic relations order. This usually comes up in the matter of a divorce. What it does is it's a domestic relations order that allows a portion of an account balance to be distributed to the ex-spouse. There are a lot of rules governing domestic relations order and what is actually qualified to be a domestic relations order for retirement plan purposes. So whenever you get one of these orders, please send them over to your account manager. Our distributions team will review the domestic relations order. They will discover if it's qualified or if it needs information to be added. But again, the rules are complicated. Don't try to sort through it and figure it out yourself. We have a team that will be able to help you through that process, determine if it's qualified, and get the appropriate notices to the participant and the ex-spouse. Spousal consent. Even though the spouse is the beneficiary for a retirement plan, unless there is spousal consent making someone else the beneficiary, most plans do not require spousal consent for a distribution. So beneficiary rules are different from distribution rules. So for a spousal consent for a distribution is typically not required. Very small subset of plans require spousal consent, and that is extremely important to get the spousal consent unless the distribution is less than $5,000. We will let you know if your plan requires spousal consent, but typically it's going to be a plan with old money purchase plan money. Money purchase used to be an option for a retirement plan many years ago. And there might be plans that are part of a floor offset arrangement with a DB plan. So very small subset of plans, typically your plan will not require spousal consent. Again, if you have any questions on whether or not your plan requires spousal consent, just ask. We'll let you know. Loans. So in addition to distributions, you can offer loans. Again, this is something that you're not required to do and just gives the participant a way of taking some funds that are repaid through payroll deduction. So a participant can take a certain amount for a loan, and we'll go over those limitations, but they are popular with participants because they can take money for a reason that you don't have to know except for certain circumstances, and we'll go over that. But they can take money from the plan, pay it back within payroll deduction, and not be taxable on that money that was received unless for some reason they default on the loan. So borrowing from a plan is not a taxable event, so it's pretty popular. And all loans must comply with certain formalities, and so we're going to go over the requirements for loan options. The most that a participant can borrow is the lesser of 50% of their account balance or $50,000 reduced by their highest outstanding balance during the last 12 months. So there is a definite limitation to how much they can withdraw from their funds for a loan. And you must also have a minimum loan amount. Typical plans have $1,000. $1,000 is the highest loan amount that you can have as a minimum. And it's really there just to make sure that participants aren't using this as a savings account. We don't want people taking loans all the time in and out of the plan. It's supposed to be used for a reason that they need to take a loan, not, like I said, as a savings account. So if a participant has a minimum $1,000 loan available, they would need to have an account balance of $2,000 that's vested. So again, participants who, in this circumstance, if they have a $1,000 account balance, they would not be eligible for a loan. They would need at least $2,000. Loans must have a reasonable interest rate. Typically, the reasonable interest rate is going to be 2 percentage points above prime. It needs to be reasonable to what they can go out in the market and get a loan for. The interest will be paid back to themselves into their account, but it does need to bear a reasonable interest rate. The loan must be repaid within 5 years unless it's for a residential mortgage loan. If you have a participant who would like to take a loan for 5 years or less, they do not need to provide documentation for why they're taking a loan. But if a participant is wanting to take a loan for 5 years or more, that is only available if they're taking it for a residential mortgage loan, and that will require documentation for that mortgage loan. Loans are paid through payroll deduction on a post-tax basis, and they're due upon termination of employment. So because loans are being made through payroll deduction, once the payroll stops, the loan repayments stop. They do have the option to repay the loan in full in one lump sum following termination of employment, but they cannot continue loan repayment as they were through payroll deduction. So it avoids you having to track down participants for the duration of their loan. It's only through payroll deduction. There are fees for a loan. There could be a loan initiation fee. There can be an annual or monthly maintenance fee, and the participant bears the cost for those loans. So even though you're allowing this in your plan, the participant is going to bear the fee for any of the loan costs. Fastest way to get a loan, participant's going to want to know. Apply online if the record keeper allows that functionality, and request an ACH transfer rather than a paper check. So that's going to be your quickest. Apply online and request an ACH. So that's going to be going through a lot of information. Again, if you have any questions, just reach out to us. We will get back to you with any answers. But we did want to go through an annual calendar of what you can expect throughout the year. Some of these are going to be duplicates for each month, depending on when your entry date is and when your eligibility is. So some of these I'm going to skip over because, again, they're repetitive for depending on when your entry date is. But I did want to point out several items. In January, just like your W-2s, the 1099s are going to be provided by the record keeper no later than January 31st. So a 1099-R is the tax form that's necessary for participants who have taken a distribution from the plan. January, typically you're going to start submitting your year-end census data to NOVA. As I indicated that some of the data requests have already gone out. The next listing, which is safe harbor plans, those data requests are going to go out on January 18th. So if you're a safe harbor plan, you have not seen your data request yet. But once you get that data request, you can start to submit your year-end census information. There's going to be a questionnaire to answer. It's going to go over some of the things we talked about as far as who's an owner, who's an officer, family members, all those types of information. And it's also going to have a tab for submitting the year-end census information. We will have webcasts. I believe we had one earlier today, but we will have multiple webcasts to go over how to submit your census data. But typically there's going to be a download option. You can download the template in Excel format, import the information into your Excel file, and then you can select the option to upload into our secure web portal. So again, download the template, fill it in, and then upload again. Participants are going to receive their fourth quarter annual statement from the record keeper in January. Typically, participants will receive a statement every quarter, so you're going to see this notification as we go through the annual calendar several times. If you have a plan that has an entry date for semi-annual, quarterly, or a monthly plan, January is going to be one of your entry dates. So you'll want to make sure that you've already provided your enrollment materials to participants, typically 30 days prior to when they're eligible. So if they're eligible January 1st, typically give their information to them by December 1st so that they can make a determination of whether or not they want to enroll in the plan. And then you'll have time to put that into the payroll process as well. Plans with monthly entry date should be distributing their enrollment material to employees that will become eligible on February 1st. So again, you're going to see this as a theme throughout this annual calendar for entry dates. If you haven't submitted your data by the end of January, please submit that data in February. There is a deadline for testing to be completed, and we have that over here in March. By March 15th, any refunds due to the failed ADP test are due to be processed by March 15th. This unfortunately does not mean that we can be turning in forms to the record keeper on March 15th. Record keepers will have a deadline prior to March 15th in which distribution forms need to be returned to them. And then they will have a certain amount of time to be able to process those and ensure that they're processed by March 15th. February, we're going to continue to work on that compliance testing. And then again, there's going to be these duplicates for entry date. Again, March 15th, big deadline for tested plans. April, again, you're going to see the statements are going to be here each quarter throughout the year. Deadline is April 15th for age 72 distributions that were deferred from the prior year. So the first distribution for age 72 needs to be made by April 15th. So that's the deadline that we're listing here. Next, an excess 402G refund. So this is for a participant who, for whatever reason, exceeded the limit of what was allowable in the year between catch-ups and the deferral limit. If a participant exceeded this limit, typically it's because they went from one employer to your employment and they may have exceeded that limit between the two of you. They will need to receive that excess back prior to April 15th to avoid any additional taxation on those, or penalties, I should say. They're still going to be taxed on it, but they're going to avoid penalties by having that process by April 15th. Next on the calendar, NOVA begins working on Form 5500 in May. So for those plans that we've completed the testing, we're going to start working on the 5500. Large plans should begin their audit. So if you are a plan with over 100 participants and you require the independent CPA audit, please get those scheduled as early as May so that we can get any information over to the auditor and they can finish their audit report prior to the 5500 due date, which is July 31st. June, we're going to continue to work on 5500 and audit work. July is the first due date of the 5500. If there is an extension necessary, it needs to be filed by July 31st. We will usually send those extensions out a week prior to the July 31st deadline to make sure that they are mailed to the Department of Labor for approval. August, we can do mid-year testing for your plan if you want to see how your testing is looking for the next year. Large plans, that plan audit should be wrapping up so that we can get that done by the extended due date. If you have a plan of 5500 due by July 31st, we talked about a summary annual report that's required to be distributed to participants. That due date is September for any 5500s that were filed by July 31st. September, NOVA is going to begin the annual mandatory cash out projects. So this is for those participants we talked about that has less than $5,000 in the plan and has terminated employment. We will start mailings out to those participants along with the record keeper to be able to start that 30-day clock for participants moving their money outside of your plan. October 15th is the fully extended due date of 5500. So by October 15th, all of your testing, your Form 5500, and your audit need to be completed by October 15th and the 5500 filed. There are lots of penalties if by the IRS and the Department of Labor if the 5500 is not filed by this extended due date. So you will receive lots of communication from us in order to make sure that you meet that October 15th and are not subject to those crazy high penalties. October, I talked about a few minutes ago, NOVA is going to begin the procedure of looking at who's 72 and send a listing to you to see who's required to take these age 72 distributions. I want to point out here the notices. If you're a safe harbor plan, you have a default investment or an auto enrollment notice. Those all should be sent December 1st. Again, the summary annual report, if you use the extension for your 5500 through October 15th, then you'll want to distribute that summary annual report to your participants. Let's see. Usually any amendments are required to be executed by December 31st, so you may have some of those pop up. And age 72 distributions, they must be processed by December 31st as well. And that's it for the annual calendar. I know we talked about a lot of notices. If you're not aware, we do have a sister company that can help with any fiduciary liability and fiduciary services. One of those is notice mailings. If you do not want to be concerned with mailing your notices, you have over 100 employees and you would rather not be involved, AFS can handle those notice mailings for you. Here is Jake's email if you want to reach out to Jake and ask him for pricing. I'll leave that up just for a second. I know we're running short on time. Actually, I think we're at time. But again, if you need that information, you can reach out to us if you didn't have time to jot down his email address. Upcoming webinar, we do have the schedule posted for 2022. We only have a few on there so far, but we do complete webinars throughout the year. So if you're interested in different topics that we have lots of them. One of them is only on safe harbor plans. So if you want more information on those safe harbor options, that's one for you. We have an errors option each year. I can't think of them all, but we have them all throughout the year. So please visit our website to look those up and register for those. Again, if you need CPA credit, you'll receive an evaluation survey and a certification within a week. And then here's my information if you have any questions, since we're not going to have time to take them through the webcast, but I will get back to you. Either you can email me, or if you've typed something into the questions box, we'll email you with the answer to those. I appreciate all of you guys attending. Please let us know if you have any questions. Hope you're having a great new year, and we will talk soon. Andrea, do you have anything that you need to jump in for?
Just really quick, if you wanted Texas CPA credit, there will be a survey at the end of the presentation. Please go ahead and complete that. We'll get your certificate to you within about 1 week. If you have any questions about the certificate or any of our other presentations, you can email webinars@nova401k.com and we'll get back to you. Again, a recording of this presentation is going to be made available on our YouTube channel if you'd like to refer back to it in the future, or if there's somebody at your company that you think would benefit from the information. Thank you everyone for attending. Thank you, Charlene, for the great information, and everybody have a great rest of your day.
Thanks, Andrea. Thanks, everyone.